get to Bob Pisani now, who has more on the early market action. Bob, what do you see?
Nice move here, Scott. Believe it or not, it's 3-1 advancing the declining stocks on the New York Stock Exchange. I know on the point basis it doesn't look like a lot, but it's a good open. We started with defensive stocks. Take a look at the sectors. Staples, healthcare, utilities were strong. But now we're seeing more cyclical names like energy and bank stocks come to the fore. You really want to see that. You need those cyclical stocks to move forward. Semis are one of the groups that are weak, and of course, that's not very surprising. Remember, yesterday we talked about that Samsung announcement about potential disruptions at their plant in Xi'an. Micron has now come out with essentially the same thing here. So there's obviously some localized issues going on. Whether this actually broadens into a real, actual international supply chain issue is not clear right now, but that's certainly a little bit of an early warning sign. You see most of the major semiconductors a little bit on the weak side. Just took a look at buybacks. You can see it today in my Trader Talk article, tradertalk.cnbc.com. The good news is we're going to hit another record year. This is an historic record for buybacks, $850 billion. The old record was 2018, $806 billion. That's the good news. The question, though, is not buybacks, is do they reduce the share counts? Remember, lower share count means higher earnings per share. That's what you want to do when you buy back stock. Unfortunately, the overall evidence is no. While there is some companies like Apple, for example, Oracle, they are actually reducing their share count. Share count in the S&P 500 is actually a little higher than it was several years ago. This seems a little odd. They've spent hundreds of billions of dollars buying back stock, and the share count is actually higher. There's two reasons why this is happening. Number one, buybacks are being replaced with more options. Executives, it's like a giant spinning wheel here, with executives getting more options even as they're exercising the buybacks. Secondly, remember, the market's a lot higher. Higher share prices reduce the amount of shares a company can buy. So $1 million doesn't buy the same amount of shares as it did a few years ago. So that's two particular problems with buybacks. So this is all part of this debate about what to do with cash flow. Companies are awash in cash flow. There's a lot of things you could do with that money. You could buy back stock. You could also increase dividends. You could reduce debt. You could do capital investment. You could do all sorts of things. The one thing I can assure you about 2020 is the buybacks are going to keep coming because corporate America is flush with cash. We may or may not have a record year, but we're certainly going to start off with a lot of buybacks. In fact, today, Kroger just today announced another $1 billion buyback. They've been actually not only buying back stock, but reducing their share count for the last several years. $1 billion buyback for Kroger. That replaces the old $1 billion buyback, and they've got a $32 billion market cap. So if they actually keep reducing the shares, that's a good sign. You know, this is not going to go away, this debate. This is a big political issue. You know, Leslie, there's the Build Back Better program that President Biden is trying to get through. That's got a 1% tax on buybacks built into it. Now, of course, the Build Back Better program is stalled in negotiations right now, but Washington's been outraged about this for many, many years, saying most of the time the buybacks just enrich the corporations and the executives that are involved. This is still going to be an issue.
Shepard Smith here. Thanks for watching CNBC on YouTube.